Integra Resources Corp is strategically positioned as a rapidly transitioning precious metals entity in the Great Basin of the western United States. The company operates the cash-flowing Florida Canyon Mine in Nevada and is concurrently advancing the highly economic flagship DeLamar Gold-Silver Project, situated in southwestern Idaho. This dual operational and development focus forms the cornerstone of the investment thesis, leveraging cash generated from the current production base to internally fund and de-risk the development pipeline, minimizing reliance on potentially dilutive equity markets. The operational foundation provided by the Florida Canyon Mine has recently demonstrated exceptional financial vigor. In the third quarter of 2025, the company reported a robust operating cash flow of $35.6 million, generating significant free cash flow amounting to $20.2 million. This performance has established a record cash balance of $81.2 million, providing a crucial capital buffer that fundamentally changes the company's financial profile. This capital strength provides internal funding credibility, significantly shielding the $282 million initial capital expenditure required for DeLamar from immediate external financing pressure. Concurrently, the DeLamar Project is demonstrating compelling technical and economic characteristics. The pre-feasibility study, PFS, confirms high-quality economics, projecting an after-tax net present value, NPV, calculated at a 5% discount rate of approximately US $412 million, resulting in an after-tax internal rate of return, IRR, of 27%, based on the conservative base case metal prices of US $1,700 per ounce for gold and US $21.5 per ounce for silver. Furthermore, the project is underpinned by an exceptionally low projected life-of-mine all-in sustaining cash cost AISC of just US $547 per ounce net of silver byproduct credits, positioning it in the lowest quartile of global producers. The primary non-market risk, permitting, has been materially de-risked with the Bureau of Land Management (BLM) formally accepting the Mine Plan of Operations (MPO) in 2025, thereby formally initiating the National Environmental Policy Act (NEPA) review process. This critical milestone accrues value by converting geological and engineering projections into an increasingly probable mine development schedule. Integra Resources Corp., which was incorporated in 1997 and was formerly known as MAG Copper Limited, maintains its headquarters in Vancouver, Canada. The corporate strategy focuses narrowly on gold and silver exploration and development within the highly prospective Great Basin region of the western United States, including assets in Idaho, Nevada, and Arizona. The stated mandate centers on disciplined capital allocation, successful mining operations, efficient project development, and strategic mergers and acquisitions (M&A). Q3 2025 operational and financial highlights. Florida Canyon delivered robust results in Q3 2025, achieving a record quarterly revenue of $70.7 million, derived from the sale of 20,026 ounces of gold. This exceptional revenue performance was significantly enhanced by an average realized gold price of $3,464 per ounce during the period. The mine is currently tracking consistently towards management's established full-year 2025 production guidance of between 70,000 and 75,000 ounces of gold.
This robust operational performance translated directly into powerful cash flow generation. Operating cash flow reached $35.6 million for the quarter, yielding a strong free cash flow of $20.2 million. The company reported record adjusted net earnings of $2.1 million for the quarter, reversing prior development stage losses. This financial momentum has been crucial in building the cash reserves, which rose to a company record US $81.2 million. Furthermore, the company strengthened its working capital position to $61.0 million, representing a 380% improvement year-over-year from $12.7 million. This dramatic increase in working capital confirms that Integra has successfully navigated the challenging transition from a capital-dependent developer to a self-funded, margin-generating producer, materially mitigating the imminent dilution risk for the DeLamar development. Cost structure and strategic capital allocation. While the headline cash costs at Florida Canyon are reported as elevated, registering $1,876 per gold ounce, this figure requires careful contextualization. Management clarifies that this elevation is a direct consequence of ongoing capital-intensive reinvestment efforts aimed at long-term improvements and sustaining future production levels. The company explicitly distinguishes between sustaining capital expenditures, necessary to maintain current production, and non-sustaining capital expenditures, which are allocated to new projects or major discrete initiatives designed to increase production or extend the mine life. The fact that the mine generated $20.2 million in free cash flow despite these significant expenditures proves the mine's high margin capacity and its function as the immediate capital source necessary to advance DeLamar without succumbing to external market volatility. The DeLamar Gold-Silver Project: Project Economics, Phase Development, and Leverage. The DeLamar Project, located in Ojai County, Idaho, is Integra's primary development asset, comprising the past-producing DeLamar and Florida Mountain deposits. The project boasts a substantial resource base, including a large measured and indicated silver resource totaling 116.514 million ounces of silver, in addition to 12.24 million ounces of inferred silver resource. The detailed technical work outlined in the pre-feasibility study, PFS, confirms that DeLamar is an economically compelling, low-risk project situated in a top-tier jurisdiction. Pre-feasibility study PFS economics and production profile. The PFS details a robust, phased 16-year life-of-mine (LOM) plan. The production scenario is anchored by a large-scale 35,000 metric ton per day open-pit heap leach facility, designed primarily to process oxide and mixed ore from both the Florida Mountain and DeLamar deposits. This initial phase is complemented by the subsequent introduction of a 6,000 metric ton per day mill, which is planned to commence operation in year 3, processing higher-grade non-oxide ore types. The annual production profile is projected to be substantial, particularly during the initial phase. Over the first 8 years of operation, the project is forecast to deliver an average annual production of 163,000 gold equivalent ounces, derived from 121,000 ounces of gold and 3.3 million ounces of silver. Crucially, the projected life-of-mine site-level all-in sustaining cash cost, AISC, is only US $547 per ounce, net of silver byproduct credits, or US $955 per ounce on an AU equivalent co-product basis. This exceptionally low-cost structure provides substantial margin protection and ensures structural resilience against cyclical downturns in commodity prices.
Capital returns and commodity price sensitivity. The financial returns of the DeLamar project are compelling under both conservative and elevated metal price scenarios. Utilizing the base case assumptions of US $1,700 per ounce of gold and US $21.50 per ounce of silver, the project yields an after-tax net present value, NPV, calculated at a 5% discount rate of US $412 million. The corresponding internal rate of return, IRR, is a strong 27%, supporting an aggressive after-tax payback period of just 3.3 years. The project demonstrates high financial leverage or valuation torque to increases in commodity prices. Under an upside scenario, using metal price assumptions of US $1,900 per ounce for gold and US $24 per ounce for silver, the after-tax NPV surges dramatically to US $611 million, with the IRR increasing to 36%. This significant increase confirms that the project's intrinsic value is highly sensitive to macro price movements, making the current equity price a leveraged bet on future precious metals market strength. Metallurgical optimization and future value addition. The current PSF incorporates a processing flowsheet designed for maximum recovery across different ore types. However, the company is actively pursuing further optimization opportunities to increase recoveries and decrease costs. Ongoing metallurgical testing includes the evaluation of run-of-mine leaching for lower-grade oxide materials. For the processing of non-oxide materials, which are currently only partially included in the study, Integra is investigating oxidative pretreatment options, such as albion processing, as well as evaluating alternative approaches like grind leach and flotation with concentrate regrind. These optimization efforts, if successful, could further improve project economics and potentially increase the resource base amenable to processing, driving the project valuation above current PSF estimates. Permitting progress and regulatory risk mitigation. For mining development projects, the permitting process represents the single largest non-market risk. Integra Resources has achieved a critical de-risking milestone by successfully navigating the initial phase of regulatory scrutiny in the U.S. Achievement of the MPO milestone. In 2025, the U.S. Bureau of Land Management, BLM, confirmed that the updated Mine Plan of Operations, MPO, for the DeLamar project met the required content specifications of the United States Code of Federal Regulations. This acceptance is a prerequisite for commencing the formal environmental review process under the National Environmental Policy Act, NEPA. This milestone is the culmination of nearly 3 years of detailed environmental baseline studies, initial engineering design, and careful description of the proposed mining and reclamation activities. The BLM's determination now allows the agency to proceed by publishing the Notice of Intent, NOI, which formally initiates the commencement of work on the Environmental Impact Statement, EIS. Strategic project refinements and scarcity premium. The MPO acceptance demonstrates management's proactive approach to mitigating regulatory friction. The updated MPO incorporated several refinements based on agent feedback, including prioritizing the placement of mine features on previously disturbed ground and relocating certain facilities to reduce potential environmental impacts on surface and water quality. This commitment to minimizing environmental footprint streamlines the often contentious NEPA process.
Furthermore, the company strategically incorporated infrastructure synergies. The updated plan leverages the refining capacity of Integra's existing Florida Canyon mine. This reduces the scope of ore processing activities and lowers the associated electrical power demands required at the DeLamar site. This simplification not only reduces project complexity and capital exposure, but also provides a more straightforward narrative for the NEPA environmental review. The successful progress through the MPO phase is particularly significant because DeLamar is identified as one of the few gold-silver development projects in the western U.S. actively advancing through the formal NEPA permitting process. This achievement confers a scarcity premium on the asset, as the regulatory risk discount applied by investors decreases materially compared to earlier stage or less developed projects. Capital requirements and financing outlook. The disciplined management of capital expenditures and the financing strategy are central to minimizing equity dilution and maximizing shareholder return during the development phase. Initial capital demand and phase structure. The pre-production capital expenditure, CapEx, required for the initial heap leach facility and associated infrastructure is estimated at US $282 million. This figure includes a rigorous 20% contingency on the processing, heap leach, and tailing facilities, providing a substantial buffer against potential inflationary pressures and construction overruns. The initial cash requirement can be further managed and reduced by utilizing conventional financing for mobile mining equipment, which is expected to reduce the upfront capital burden by approximately US $26.4 million. While the total life of mine (LOM) capital expenditure, including pre-production, expansion, and sustaining costs, aggregates to US $576 million, the phased development strategy is designed to manage this outlay efficiently. Financing strategy and equity dilution mitigation. Integra's financing strategy is notably sophisticated for a developer, demonstrating a deliberate effort to control capital sequencing risk. Management plans to finance the mill expansion capital, which commences in year 3 of the LOM plan, utilizing internal cash flows generated by the initial high-margin heap leach operation. The rapid 3.3-year payback period and the robust internal cash generation capacity of the initial phase make this strategy financially viable. This approach of staggering the CapEx burden with the expansion phase self-funded by the operational phase minimizes the risk of stock dilution for the majority of the project's LOM spending. The current US $81.2 million cash reserve derived from Florida Canyon further strengthens this position, providing a compelling buffer that makes non-dilutive debt financing for the initial US $282 million CapEx highly probable and preferable. Post-recent corporate consolidation, the non-diluted share count stands at approximately 121.8 million Integra shares, meaning managing capital efficiently is critical to preserve per-share value.
Valuation and macroeconomic context. Analyst consensus and implied upside. Market analysis indicates that Integra Resources is currently undervalued based on consensus analyst price targets, suggesting significant implied upside potential. Projections from various analysts show the average 12-month price target ranging from a low consensus of $4.89 to a higher consensus of $6.56. Based on recent trading prices, this suggests an implied upside potential ranging from 14.88% to 24.74%. This valuation disconnect likely stems from the market not yet fully recognizing the economic power of the de-risked DeLamar asset, combined with the sustained positive free cash flow generated by Florida Canyon. Macroeconomic tailwinds and price forecasts. The investment case for Integra is significantly enhanced by prevailing structural trends in the precious metals markets. Following a strong rally in 2025, the gold price is widely expected to moderate but consolidate at a much higher level in 2026, potentially establishing a baseline between $4,000 and $5,000 per ounce. This structural bull cycle is supported by robust central bank and retail demand, geopolitical factors, and concerns surrounding global debt. Silver is forecast to follow gold closely, buoyed by structural supply deficits and heightened industrial and investment demand, notably from the photovoltaic (PV) and electric vehicle (EV) sectors. Integra is positioned ideally for a major re-rating as two primary value catalysts converge: the successful advancement and de-risking of DeLamar through the critical NEPA process and the sustained upward trajectory of gold and silver prices. Because the DeLamar Project's valuation, NPV, expands dramatically as the gold price strengthens toward the $4,000 per ounce level, the current share price provides high leveraged exposure to macro commodity price appreciation. The stock is expected to converge toward and potentially exceed the upper range of analyst price targets as the intrinsic asset value is fully incorporated into the market capitalization. Key investment risks and mitigation strategies. While the outlook is highly positive, an exhaustive investment analysis must address the principal risks associated with this development stage producer. Operational concentration risk. A significant near-term risk remains the concentration of the company's current financial stability on the operational continuity and success of Florida Canyon. Any unanticipated disruption at this single operating asset could severely impair the cash flow used to fund DeLamar development. This risk is actively being mitigated by using the high cash flows to build a substantial US $81.2 million cash reserve and by aggressively advancing the DeLamar project to achieve multi-asset diversification.
Permitting and regulatory risk. Despite the acceptance of the MPO, the complex NEPA and EIS review process involves numerous governmental and stakeholder consultations and carries an inherent risk of delays, scope changes, or adverse findings, particularly in a high-profile U.S. jurisdiction. Management is mitigating this by strategically refining the MPO to address agency concerns directly, notably by prioritizing disturbed ground placement and leveraging existing off-site corporate infrastructure, Florida Canyon refining capacity. This intentional reduction of environmental friction is designed to expedite regulatory approval. Execution and capital cost risk. The US $282 million initial capex for DeLamar exposes the company to risks inherent in major construction projects, including inflationary pressures on materials and labor, as well as potential scheduling delays. The primary mitigation strategy involves the inclusion of a robust 20% contingency within the capex estimate, providing a significant financial buffer. Furthermore, the management team's extensive history in developing, constructing, and selling complex mining assets substantially reduces the risk of operational inexperience. Commodity price volatility. Short-term volatility or an unexpected macro reversal in gold and silver markets would immediately suppress margins at Florida Canyon and negatively impact the valuation of DeLamar. However, the DeLamar project's structural resilience is exceptionally high due to its remarkably low all-in sustaining cash cost of US $547 per ounce. This low-cost structure ensures that the project remains economically viable, maintaining profitability even in severe downside commodity price scenarios, thereby protecting its long-term asset value. Conclusion and forward-looking recommendation. Integra Resources Corp presents a high-leverage investment proposition underpinned by a successfully executed transition into a cash flow positive producer. The company's core value is derived from the synergistic deployment of capital generated by the Florida Canyon mine to de-risk and advance the DeLamar Gold-Silver project, a large-scale, low-cost asset situated in a premier U.S. jurisdiction. The DeLamar project's validated PFS economics, featuring an after-tax NPV reaching US $611 million in an elevated price environment, and an industry-leading AISC of US $547 per ounce, solidifies its position as a high-margin asset destined for premium valuation multiples. Critical de-risking milestones, specifically the BLM acceptance of the mine plan of operations, have reduced permitting uncertainty and positioned the company to capture an increasing scarcity premium within the western U.S. development landscape. The strategy of using internally generated cash flows to fund the mill expansion mitigates external equity risk for the total life of mine capital, a critical factor for capital-conscious investors. Given the convergence of positive financial performance, successful de-risking, and structural bullishness in the precious metals market, the company is poised for a significant valuation re-rating that should close the gap between current prices and consensus analyst targets. The stock offers attractive exposure for investors seeking a balance between operational stability and leveraged growth potential.